Okay, so this is the video that will finish off chapter 14, that in-class assignment portion. We've got a few questions to finish up. The first one we're doing is 14-8 that relates to treasury stock. Now this question's a little bit different and it's more like one of those math word problems than it is, the usual layout where everything is laid out very clearly for us. So we need to read through and decide what we need to record, make all of our journal entries, and then figure out our final balances. So on January 1st, we have the issuance of 375,000 no par common shares. In 20X5, there were treasury stock transactions. So we had one on January 15th where we purchased some treasury stock, March 1st where we sold some treasury stock, March 15th where we made another purchase, the 31st where we sold some more, and then on June 1st when we retired the shares. So we have the starting balance for retained earnings, and we're going to provide all the 20X5 entries. So it's not required for us to record the initial entry on January 1st of 20X1, where we issued these common shares, but it is good practice for us, so we'll include that journal entry. We know when we sell shares, we're going to increase our cash asset for the cash that we're receiving from our shareholders, and then we're going to increase the related contributed capital account, which is our common shares account. So it was 375,000 shares, and they were sold at a price of $4 each, which is going to, I think I missed a zero, give us a balance of 1.5 million. And this was for the issuance of 375,000 common shares, $4 each. So then we can move on to our 20X5 transactions. The first one occurred on January 15th. And in this case, we are purchasing treasury stock. So we're going to increase our treasury stock, and we're going to decrease our related cash asset for the amount that we purchased. So in this case, 4,200 at a price of $3 each gives us a balance of 12,600. The next transaction that occurred was on March 1st. And in this case, we sold 750 shares of treasury stock at $4.50 each. So we know that when we sell treasury stock, we're going to increase our cash asset for the amount of cash that is received. We're going to adjust our treasury stock account, and this is for the number of shares sold at their average price. And then if we have a difference between our debits and credits, we'll need to look if we need to use the contributed capital from treasury stock transactions or retained earnings. So we'll start off with the easy part, which is the cash that we're going to receive. 750 shares at $4.50 each is going to give us an amount of $3,375. Our treasury stock didn't have an existing balance, so our average is going to be the $3 per share from our January 15th transaction. 750 shares at $3 each gives us an amount of $2,250. Of course, we have a difference between our debits and our credits, which means we will need an additional credit to make our entry balance. When we are crediting, we use our contributed capital on our treasury stock transactions. And this was for the sale of 750 treasury stock, $4.50 each. On March the 15th, we purchased 500 shares of treasury stock at $1.42. So our entry is going to be the same as that January 15th. We'll adjust our treasury stock account and we will decrease our cash asset for the amount of cash that was spent. And again, 500 shares at $1.42 each is going to give us a balance of 710. And this was for the purchase of 500 treasury stock at $1.42 each. On March 31st, we made another sale of 850 shares of treasury stock at $1.75 each. So this is similar to our March 1st transaction. We know that we're going to receive cash, right, for the sale of the shares. So 850 at $1.75 each gives us 1,488. We're then going to adjust our treasury stock and decide if we need to use contributed capital or retained earnings for the difference. So the first thing that we need to do now is figure out our new average because we've had two purchases of treasury stock at this point. So our first transaction to treasury stock was for $12,600. We then decreased our treasury stock by $2,250, which we don't need to include because that was on a resale, not a purchase. So we're going to add the 710, which gives us a balance of 13,300. Sorry, I'm losing my mind this morning, guys. Sorry, we are going to take out the 2,250 from our March 1st transaction, giving us a balance of 11,060. And this is in relation to 4,200 shares that we purchased, and then we sold 750, and then we purchased another 500. When we divide the balance by the number of shares, we get an average of $2.80. So our 850 shares multiplied by $2.80 is going to give us 2,380. So this time we need an entry on the debit side in order to make our transaction balance in the amount of 893. And we need to decide, are we using contributed capital or are we using retained earnings? So we look at the balance of contributed capital on stock transactions. We've had one entry for 1,125 on the credit side, which means that we can debit this account to cover the $893 difference. Okay? If this amount was greater than our balance in contributed capital, then we would need to use retained earnings as well. And this is to record our sale of 850 treasury stock at $1.75 each. And then finally, on June 1st, we're going to retire our outstanding treasury stock. So we're going to have to look at how many stocks we are retiring. We had 395, and that was prior to our sale of 850, which means that we still have 3,100 shares outstanding. Okay. So when we retire shares, we know that we are going to take them out of our common shares contributed capital. So this was this account that we used up here. And those shares were initially issued at $4 each. So the number of shares we're retiring multiplied by $4 is going to give us an amount of 12,400. Next, we're going to look at the effect on our treasury stock account. Again, we have 3,100 shares that we're going to retire, and the average of those shares is $2.80. This transaction does not affect our average because it is a sale rather than a purchase. Sorry about that. So then when we look at the difference between our debits and our credits, we need an additional credit of 3,720, and we're going to use that contributed capital from share retirement. Okay, so this is a different contributed capital than our treasury stock transactions. This is based on our retirement amount. Okay, and this is to retire our outstanding treasury stock. So the second requirement of this is to figure out our account balances. Okay, so we're going to start with our common shares that are issued and outstanding. We know that we issued 375,000 to start. Okay, we then repurchased 420, but that's not really affecting our common shares outstanding at this point. So really what we are looking at here is only the shares that were retired. Okay, the treasury stock is still outstanding and being reissued. Those shares are still technically in circulation. But when we look at the shares that we retired, which was 3,100, we're going to get outstanding shares in the amount of 371,900. So our initial balance in our common share account was 1.5 million. We then debited that account for 12,400, which is going to give us a balance of 1,487,600. Next, we're going to look at the balance of our contributed capital for treasury stock. So we gave that a credit for 1,125. We're going to subtract the debit for 893. And there was only the two transactions affecting that account. So we have an amount of 233. When we look at contributed capital on share retirement, we only had one transaction that affected that account. So 3,720 is the balance of that account. And when it comes to retained earnings, we had an initial balance of 962,500, and none of our transactions actually affected retained earnings because we used those contributed capital accounts the whole way along. So our retained earning balance is going to remain the same as well. Okay. So the next question is technical review for 14-6 we already did at the beginning, I believe. Or I might have removed it as one of the requirements. Yeah, I think I removed it. Either that or I'm missing some questions on this spreadsheet. So we'll continue on with the questions that we have on here. And if needed, I will do another quick video, or we'll talk about 14-6 in Monday's class. It won't be a requirement. It's just a good question sort of to wrap your head around. So the next one is 14-9, and this is this is a question that's looking at our other comprehensive income. So on December 31st, Wave Exploration Limited had all of these different shareholders' equity accounts. We need to calculate the balance in each equity account, reflecting the disposition of 20x7 comprehensive income. And then we need to explain the meaning of each account and what would make that account increase or decrease. Okay? So our retained earnings had a balance of $900,000. We then see accumulated other comprehensive income related to our fair value amounts of $50,000. We have accumulated other comprehensive income relating to foreign currency, a net amount of negative $230,000, and then we have some earnings and some other comprehensive income as well. So when it comes to our retained earnings, we of course have our initial balance, and then the only other thing that is affecting that retained earnings directly is going to be our earnings of $287,000. Okay, so those are the only two transactions that are impacting our retained earnings directly, which is going to give us a balance of $1,187,000. So next we're going to look at our accumulated other comprehensive income through those fair value investments. So we started with a balance of $50,000. And then we can see that we had a net loss of $35,000. So we're going to subtract that. And that's going to give us an amount of $15,000. Sure why I have so much space in between these. So next we'll look at accumulated other comprehensive income relating to our foreign currency. So we had an overall loss of $230,000. And then we see that we actually had a gain in 20X7 of $20,000. So because that's a negative number representing the loss, we're going to nope, I did it the wrong way. Sorry. I always get confused with Excel and doing the negative and positive. We're going to get an overall loss of $210,000. Okay, so our loss has decreased from the first year to the second year. So the second thing is to explain the meaning of each account and what would make each account increase or decrease. So I'm going to read sort of the textbook solution part of this. You don't need to try and write everything down. It's for informational purposes. So retained earnings represents our accumulated earnings less our accumulated dividends. It's also adjusted for capital transactions such as losses on share transactions, share issuance costs, retrospective changes in accounting policy, and so on. The reserve for our fair value investments represents our recorded unrealized changes in fair value. The reserve increases or is a credit when fair value increases, and it decreases when fair value decreases. Realized amounts may be transferred to retained earnings if the company chooses, but not to earnings. The reserve for foreign currency is caused by the presence of a subsidiary whose books are kept in a currency other than the reporting currency. This reserve is the cumulative translation gain. The reserve increases equity, so is a credit when there is an exchange gain, and it decreases when there is a loss. The amount would be transferred out of the reserve when the subsidiary is sold. Okay, so impacts to that account are going to be kept track of over time until that one is actually sold. So I'm going to pause the video here. I have a quick meeting to attend, and then I will do the second video looking at the rest of the questions.